Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is John Champaglia, CEO of Sprott Asset Management, and we are talking about investing in nuclear renaissance. John, welcome back. Great to have you on the show today.
Yeah, great to be back. Good to chat again.
Yes. So last month, Microsoft announced a 20-year power purchase agreement with Constellation Energy. And Constellation is the largest owner of nuclear power plants in the US. And under this agreement, Constellation will restart Pennsylvania's 3 Mile Island nuclear reactor, and that will be required to generate power needed for Microsoft's data centers. And probably our listeners will remember that one of the site's 2 reactors was closed in 1979, following the worst nuclear accident in US history. The other reactor was undamaged, and that was shut down in 2019 due to high operational costs, and that is the one which is being revived now. And today, we heard from Google CEO Sundar Pichai, and for reference, we are recording on October 3rd. So he also said that he's planning to bring electricity from nuclear power plants to Google's data center. And this, because of these announcements, shares of Constellation Energy and Vistra, they have been surging. In fact, Vistra is now up more than 230% year to date. It is the best performing stock in the S&P 500 index, even ahead of NVIDIA. So let's start with the implications of these announcements for nuclear energy.
Yeah, sure. It is very exciting times, and this news development's been rumored for a number of months, so it's great to see it come to fruition. But let's just maybe take a step back and ask ourselves, what's the catalyst? What is really going on behind the scenes? And the simple answer is, for the last 20 years in the United States, the grid load has largely been static, meaning the amount of electricity that the US economy has needed has largely been flat. And that's just because engineers are very, very crafty in terms of making things more energy efficient. And something's happened in the last couple of years. And I'm just going to read a quote that I think really summarizes it well. Earnings calls from electric utilities mentioned increased energy demand 120 times in the recent quarterly earnings cycle, up 3 times from just a year and a half ago. So what's going on? Why are all these utilities saying that their customers are asking for more electricity? Well, it's a number of things. 800 new manufacturing facilities have been planned in the United States. That is everything from semiconductor plants, electric vehicles, electric batteries, large-scale grid batteries, clean technologies, solar panel, defense industries, you name it. This is really about reshoring many critical supply chains away from places like China. I think COVID was a real wake-up call in terms of how reliant we were on a number of countries. And then more recently, in the last couple years, we saw countries that we once did trading with and we were friendly with become difficult to deal with, like Russia. So there is a big shift going on to reshoring a lot of this manufacturing. It's obviously being encouraged and incentivized by the Inflation Reduction Act, the bipartisan infrastructure law that was passed a couple years ago. So there's a lot of government money that's trying to crowd in private capital. And then more recently, you have this phenomena of AI data centers. And what's important to know about AI data centers is twofold. One, there's a race going on around the world to become leaders in the space, and the US clearly has that in its sights. And second of all, data centers, AI data centers, are much more energy intensive than a traditional data center. So for example, if you are doing a Google search and you're obviously, connecting to a data center somewhere, if you compare the amount of electricity usage for that relative to doing an AI related search, it's 7 times more power intensive. So the Microsofts and Metas and Apples and Oracles and Googles and Amazon cloud services of the world are all in this race to build out AI data centers. One estimate says that major tech companies are expected to invest $1 trillion in new data centers over the next 5 years. And in the next 5 years, consumers and businesses will generate twice as much data as all the data created over the past 10 years. So just to put that into context, right now, data centers consume, as of 2022, about 2.5% of overall US electricity demand. If you look at different estimates going out to 2030, I've seen some as low as 6% of overall electricity demand, and I've seen some as aggressive as 9%. So this is what's driving a big part of the grid demand that's building. And so if you're a Microsoft, you're going to your local utility and you're asking them for more power. And in some cases, the answer is, okay, we can provide you that power, but it might take 5 or 6 years to, design it, permit it, finance it, build it. And Microsoft's basically saying, sorry, we're not waiting around because we're in a race. And they're taking matters into their own hands. They are doing very substantial deals with renewable energy companies like Brookfield, which they announced a $10 billion power purchase agreement just a few months ago. And then the one obviously related to nuclear energy is the restart of 3 Mile Island 1, which again, it's an existing power station that can provide a lot of clean, firm power. And yes, solar and wind are clean sources of power, but they're not firm, they're intermittent. And you obviously cannot run a data center using power sources that run on average 25 or 35% of the time. In sharp contrast, once you fire up a nuclear power station, they run continuously 365 days a year, 24/7, unless you need to do maintenance or refuel them, which is about every 18 to 24 months. So it's the perfect match in terms of the energy source with the energy demand. And I think that's why there's a lot of excitement. Now, why people are even more excited about it is because it's a bit of a copycat strategy. You heard in the last few days, Google saying, we're going to build a whole number of small modular reactors, and Oracle has said the same. And so I think they are all going to replicate this strategy, whether it's existing power stations that have been shuttered or perhaps building new capacity on existing sites. And there's also another power station, nuclear power station, that is in Michigan that's been closed for 2 years, that is in the process of restarting as well. So this will be the first 2 case studies where a shuttered nuclear power station in the United States could come back into production.
Right. So let's talk a little bit more about these small modular reactors, because these traditional nuclear reactors, they may take years or even decades to build. And there are not many reactors that are just lying idle, like 3 Mile Island, which can be restarted. So obviously, there's a lot of increased interest in these small modular reactors, or SMRs. And you mentioned Oracle. So Oracle CEO Larry Ellison said recently during the earnings call that Oracle is designing a data center which will be powered by 3 small modular nuclear reactors. And I understand Bill Gates-backed TerraPower is also developing small modular reactors. So could you tell a little bit more about these reactors? Are these commercially viable? And how many of these smaller reactors we are likely to see in the coming years?
Yeah, it's a great question. So if you think about a traditional large-scale nuclear reactor, there's usually 2 or 3 or 4 reactor cores. And they can be anywhere from 800 to 1,000 megawatts. So they produce enormous amounts of energy and can power, hundreds of thousands of households and businesses. But they have a couple of knocks against them. One, they're very expensive to build. Two, they're really ideal for powering large scale, cities and whatnot. And three, we stopped building them for the most part. We haven't really been building these for the greater part of 30 years. We've built, I think, 3 new reactors in the United States over the last 30 years. So we've kind of lost that knowledge and workforce. And so one of the ideas to address some of the shortcomings is to create a small modular reactor, and think of it as almost a smaller scale reactor that could be 100 to 300 megawatts, that would be built in a factory, almost like an airplane, and then assembled on site. And you could basically build them side by side by side to kind of scale up whatever you needed. So the idea here is that they have a lower price tag, they're easier and faster to build, and they are very versatile in terms of all the different applications. There are somewhere in the neighborhood of 80 different designs being worked on globally, everything from producing electricity to producing industrial heat to other applications. And right now, I'd say we're in the period of approvals and commercialization. There are a few that have been approved and by different authorities, and some are in the planning stages for construction. But it's still several years away before we will see many of these new designs get financed, built, and scaled. But I think the industry is very excited about this application for the reasons I outlined. The US government has passed a piece of legislation called the ADVANCE Act, which is going to help facilitate the funding and the approval process for these new designs. And where I live in Canada, actually, we're in the process of breaking ground right now and building 4 of these things. So we may be the first in the world to have a number of these small modular reactors. And I think for data centers in particularly, they're well suited, because if you think about, building an SMR with 300 megawatts of capacity, that could power a very large data center. So I think this is why the oracles of the world are publicly talking about their ambitions to leverage this emerging technology.
Very interesting. So now from this next generation technology, SMRs, let's move on to something which is even further into the future, nuclear fusion. So currently all commercial nuclear power plants, they use fission, and nuclear fusion, which is kind of opposite process, and it is the process that fuels the sun and the stars. So that could potentially provide a virtually unlimited supply of carbon-free energy if it can be controlled on Earth. And nuclear fusion reactors, they are also in experimental stages and not commercially viable. But I have seen claims that commercial fusion is just a few years away. And I've also read that maybe fusion power is decades away. So tell us about the race for commercial fusion. How far is it from us?
Yeah, well, it always seems as though it's 10 years away. And that seems to be the reality. There is significant private capital funding a number of fusion-related startups. But as you said, I think a lot of the stages of development are still at experimental and very small-scale demonstration. For the sake of my kids and hopefully my grandkids one day, I'm very optimistic that we will be able to figure out this technology, because if we were to do it, you essentially wouldn't need the entire oil and gas industry. For one, you would completely change everything about your energy mix. But I think it's fair to say that we're still 10 plus years out before we have real meaningful proof that the concept works. So for the time being, governments around the world are focused on nuclear fission, as you mentioned, which are the traditional nuclear power stations.
Right, very interesting. So we'll be watching the developments in this area very, very closely. And with so many reactors around the world under construction or being, or even under planning stage or being restarted, there is going to be a lot of demand for uranium. So let's talk about the supply and demand situation for uranium. And spot uranium prices had peaked in February. And now, in fact, they are down slightly year to date, I understand, even though since the start of 2020, uranium prices are up about 230%. And over the past month or so, they have surged again. They're up about 20%, or a little more than that, because we heard about Russian President Vladimir Putin's announcement that he's asking officials to consider restrictions on exports of uranium and other critical commodities. And one of the largest uranium producer, they had cut their production target. So tell us what is going on in uranium prices. Why is there so much volatility in the pricing?
Yeah, no, there's a lot to obviously unpack there. I mean, I'll just start off with, the kind of current state of the uranium market. We remain in a structural supply deficit, which means we don't produce enough uranium each year through different mining techniques to replace the uranium that the 430 odd reactors today consume. And as you correctly pointed out, it's not just about the 434 reactors that are operating today. It's about the 60 that are being built, and there's over 100 being planned. So who's driving that? Well, it's obviously places like China. They're building between 4 and 6 new reactors every year. India, as well, is going to be a large builder of additional capacity, but it's all over the place. People are considering adding nuclear power. So today we have, let's say, a 30 million pound deficit, meaning we produce about 150 million pounds and we consume about 180. Where it gets more interesting is if you go out in time and you look at all of the future builds and what their anticipated uranium needs will be. The WNA, the World Nuclear Association, forecasts that by the year 2040, the annual demand for uranium will go from 180 million pounds to 300 million pounds. And so you're kind of sitting there saying, wow, the industry has to figure out how to double production between now and 2040. Now, what makes that challenging, even though markets are very responsive and when market signals are sent out, companies will respond and increase production. The challenge is we stopped building uranium mines for a very long time. And the ones that are operating today have been around for a very long time. Some of them are coming to end of life. And that the time and money to bring a new project online can be quite extensive in terms of money and time. And so it is a bit of a race against time. The second thing that's making things complicated is Russia. Now, Russia is not an important producer of uranium itself, but it is a very important part of the nuclear fuel supply chain where uranium is enriched from its natural state to a higher level so that it can be used for civilian nuclear reactor purposes. And Russia controls about 40% of the world's capacity. Now, how does that play back into the United States? Well, about 20 to 25% of the enriched uranium that US utilities purchase to this day still comes from Russia, even though we're kind of 2.5 years into this war with Ukraine. Now, the Department of Energy in August passed a law saying that as of the end of 2027, there will be no more importing of Russian enriched uranium in the United States. And between now and then, if you are going to request permission to do that, you need to get a waiver. And some of those waivers are starting to be given out. But we think this is part of a larger reshoring of the supply chain away from Russia. And there's been a number of very important announcements made about building new capacity, not just in the United States, but in friendly countries such as Europe. Now, all of those things are having a tremendous impact on the price of uranium, both in the spot market and the term market. And as you said, we started this year at around $91 a pound in the spot market. We got as high as 106. We had a pretty healthy correction where we got down to about $79.50. And right now we're at about $82. So we've had some volatility in the price, but we think that the price longer term will continue to go up. As you said, it's gone up enormously in the last 3 years, but we think there's still more potential for it to run because of the amount of uranium we need to incentivize to come to market. And this is starting to happen, obviously. Many of the mines that have been on care and maintenance for the last 6, 7, 8 years, in some cases, mines that haven't operated for 15 years are coming back online. That's obviously very, very helpful for the uranium mining companies, which is why, as a group, those companies have done very well over the last few years. And it's why we continue to remain very bullish on not just the physical price, the price of physical uranium, but also the related uranium mining equities. And then lastly, Kazakhstan, you have to bring them up because they're the world's largest producer of uranium. And about 6 weeks ago, they told the world that they were going to miss their production by 17% next year. And that's a meaningful number because they had previously planned and signaled that they were going to flex up production. And they clearly are unable to do that at this time for a number of reasons. And so, supply is becoming harder to bring to market than I think some people were anticipating. So there's a lot of moving parts, and it's a very interesting commodity that we think has a few more years to go before we hit peak pricing.
Very interesting. So you offer a physically backed uranium fund in Canada, which is listed in Canada. And in the US, you offer a uranium miners ETF, ticker symbol is URNM. And in full disclosure, I own it in the ETF investor portfolio that I manage. And it is probably the most volatile holding in my portfolio, but I believe in the longer term outlook, the bullish outlook for this fund and uranium miners in general. So could you talk a little bit about these two funds?
Yeah, sure. So Sprott has a flagship product called the Sprott Physical Uranium Trust, which owns physical uranium. Believe it or not, it's basically a yellow powder that's stored in steel drums. It's a very safe inert form of uranium. That fund is a little over $5 billion, and it actually trades in the US on the OTC best market. SRUUF is the ticker. Our flagship uranium mining equity fund, as you mentioned, is URNM. And what that fund does is gives you exposure to an index, which really tries to provide exposure to the whole cross-section of uranium mining, as well as some allocation to physical uranium itself. So you get the largest producers in that index, which are Cameco and Kazatomprom, the state-owned Kazakh company. You get almost 20% exposure to physical uranium, primarily through the Sprott Physical Uranium Trust. And then you get a whole host of exposures through smaller producers, emerging producers, and exploration stage development companies. And as you mentioned, it is very volatile. These are smaller cap stocks in many cases. Many of these companies are pre-revenue because they're still trying to develop mines that were discovered many, many years ago and left idle in the ground due to uneconomic pricing. But if you look at how those funds have done the last 3 years, despite their volatility, they've performed very well. And that's just because the underlying fundamentals that I just laid out for you have really propelled valuations and prices higher. So there are two very popular ways to gain exposure to this thematic. I think, ETFs for sector funds like this, particularly volatile ones, are a more interesting way, I think, for many investors to invest, in the segment versus buying individual stocks, which can be even more volatile.
I agree with you. So let's talk a little bit about the broader energy transition theme and critical materials that are needed for energy transition. So other critical materials like copper, nickel, cobalt, lithium, they also will be needed in addition to uranium for clean energy generation, battery storage, and energy transmission. Could you talk a little bit about the outlook and demand and supply situation for these materials?
Sure. So there are a lot of minerals related to energy transition. And energy transition is basically a term to describe cleaner forms, meaning lower greenhouse gas emitting forms of electricity production, metals related to transmitting energy, and then metals related to storing energy, i.e. batteries. So if you think about creating energy, the main minerals there are uranium for nuclear power, things like silver. Why silver? Well, that's for solar panels. It's a key mineral. And then there's a lot of copper and some rare earths in things like wind turbines, permanent magnets, for example. They use certain rare earths. And copper is really universal to a lot of these technologies. Transmission of electricity, obviously, copper is the star there. It is highly conductive metal. So everything you can imagine from EV charging to EV batteries to cabling, electronics. There's a lot of copper in data centers. And so all of these metals are getting a boost from the investments going on in this space. And then finally, on the energy storage side, it really comes down to things like lithium, which is the primary electrolyte in batteries, cobalt, class 1 nickel, manganese, graphite. And the thing that I think people have figured out is how dominant China is in most of these supply chains. So if you think about copper, half the copper that's produced in the world goes to China. It goes there to get processed and mostly consumed. 80% of the solar panels, for example, are made in China. Over 80% of EV batteries are made in China. So a lot of these supply chains and the related metals are controlled and dominated by China. And that's something that obviously Western governments have taken notice of. And really what they're trying to do is to encourage and incentivize more local production, mining of these minerals, not just on home soil, but within friendly countries. So you've seen a number of strategic alliances being announced around critical minerals by places like the US, the EU, which are signing deals with Australia, Canada, Chile, Peru, traditional mining jurisdictions that have a lot of these minerals. So we think that's very positive. And if you think about, what we need to do in terms of greater electrification and the growing adoption of EVs, particularly in places like China, it's really underpinning a lot of new demand for these critical minerals. So the one that I think most people are focused on today is copper. We've been mining copper for thousands of years, so it's not this is not a new industry like, say, lithium is. But the challenge with copper is we found all the easy stuff. We've been mining it, as I said, for thousands of years, and the grades of copper ore have steadily declined as we found the easy stuff. And we're now being forced to go deeper underground to find these deposits, or go higher up into the mountains, like in the Andes, where most of the copper is mined. And it is becoming more supply constrained. And copper, I think, has a very interesting dynamic because it's becoming less and less sensitive to just general economic growth. Copper was often referred to as Dr. Copper because it would give you a sense of the health of the overall economy. Now we're starting to see copper behave differently than traditionally economically sensitive metals like iron. So if you look at the price of iron ore, it's gone down this year, and copper has gone up. And that's just because copper demand is really being driven by new industries, whether it's grid infrastructure, solar farms, wind farms, electric vehicles, etc. So copper is the one that I think people are most intrigued by right now. Lithium has had a very severe correction in price. There was a shortage of lithium 2 years ago, which forced the price to go up multiple fold. That deficit has been fixed, and now the market, I would say, is probably dealing with a small surplus, and the price of lithium has corrected quite significantly. Having said that, we still think the demand for lithium is going to be significant in the coming years, as many places like China are really moving very aggressively to electric vehicles, plug-in hybrids, and hybrid vehicles. So we see continued demand for battery technology, including large-scale batteries, which are going to back up solar farms. So you fill up the batteries when the sun is shining, and then obviously draw down the energy at nighttime when the sun is not out. The other metals, I would say, all have smaller roles to play. Nickel is another very important battery for electric vehicles, but obviously nickel is a lot more plentiful, and right now the market, I would say, is balanced. But copper, I think, is the one that people are most intrigued by right now.
Excellent stuff. John, we'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thank you so much for having me. I always enjoy chatting.
That was John Champaglia, CEO of Sprott Asset Management. Let's quickly recap the tickers that we discussed. So we talked about nuclear power producers, Constellation Energy, the ticker symbol is CEG, and Vistra, the ticker symbol is VST. These are among the best performing S&P 500 stocks year to date. Then we talked about the Sprott Uranium Miners ETF. The ticker symbol is URNM. Global X also offers a similar ETF, the Global X Uranium ETF. The ticker symbol is URA. And then we talked about the Critical Materials ETF to invest in the broader energy transition theme. And the ticker symbol of that ETF is SETM. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.